Pull up two numbers with me right now. On Monday, silver delivery period on the COMEX, 1,181 contracts were issued for physical delivery. That's 5.92 million ounces of silver in one day, from buyers who had been sitting at the gate since first notice day, ready to pull the trigger the moment the window opened. Tuesday comes, same market, same delivery period, 3 contracts, not 300, not 33, 3. That's 15,000 ounces across the entire COMEX silver market on day 2 of what should be an active delivery cycle. One day, 5.9 million ounces. The next, 15,000. Now flip to platinum. On that same Tuesday, the COMEX platinum market processed 398 delivery contracts in a single day. Month to date across both metals, platinum has officially crossed silver in total deliveries, 1,021 contracts to silver's 1,184. Let that register. Platinum, a metal most retail investors have never actively traded, a metal with a market cap that doesn't come close to silver's. Platinum deliveries are outrunning silver deliveries in the same month on the same exchange, with Goldman Sachs, JP Morgan, Citibank, Macquarie, BNP, ABN AMRO, Wells Fargo, RBC, and the rest of the institutional roster all standing for platinum, and silver got 3 contracts on Tuesday. I'm John A.G., and I want to think through exactly what this data is telling us, because right now there are 2 possible explanations for what just happened, and only one of them should make you comfortable. The first explanation is the one that says, nothing is wrong. The argument goes like this. Monday's 1,181 contracts were buyers who had been stacking up since first notice day, aggressive and front-loaded, determined to get their metal immediately. February's delivery cycle saw 1,181 contracts on day 1. March followed a similar pattern. These buyers don't spread their demand across the month. They show up on the first day, take the metal, and disappear. So, Tuesday's 3 contracts could simply mean the hungry buyers already got what they came for on Monday, and the remaining participants are rolling their positions, waiting, or fully satisfied. That is a legitimate reading. I want to be fair to it. This channel doesn't do manufactured panic. But here's the second explanation, and this is the one that keeps me looking at the data again. After 1,181 contracts demanded delivery on Monday, 5.92 million ounces pulled in a single session, the short side of the market may have run into a quiet, undeclared problem, not a headline-generating default, not a public emergency, something more subtle. The pool of registered silver that is actually available, unencumbered, properly warranted, and eligible to back a new delivery notice may have effectively dried up. And on Tuesday, only 3 of those notices could be generated. Not because demand evaporated overnight, but because the free float, the metal that isn't already committed to a prior delivery, wrapped in a swap, out on a lease, or informally promised to someone else, had largely disappeared after Monday's draw. Think about what that framing means. 1,181 contracts, then 3. That is not a demand cliff. That is a supply ceiling. And the publicly available data doesn't let me definitively tell you which explanation is correct. I want to be honest about that limitation. But here's what the platinum numbers are doing to the first explanation. Macquarie alone issued 390 platinum delivery contracts in a single day. Goldman, JP Morgan, Citi, BNP. These are the same institutions that actively trade silver. They showed up in force for platinum on a day when silver's entire delivery apparatus produced 3 notices. These are not small players taking different positions on a whim. Their behavior in platinum makes the demand just front-loaded story for silver harder to hold on to. And then there's gold, because gold is running a parallel story right now that you need to understand. About 9 days ago, gold touched the $4,100 level, and the financial press declared it a broken trade. I watched analysts who couldn't find the COMEX on a map confidently announce that gold's bull run was finished. Safe haven fails. War trade exposed. The asset is done. Today, gold is sitting near $4,700 and pushing back toward $5,000. 9 days. Here's what actually happened. Gold entered 2026, having gained nearly 96% in a single year. It hit an all-time intraday peak of $5,626 on January 29th. By the time the Iran conflict escalated on February 28th, the trade was dangerously crowded. Leveraged positions were layered on top of each other. A Strait of Hormuz closure meant higher oil prices, higher inflation, higher rates for longer, and that combination wiped out rate cut expectations almost instantly. For a non-yielding asset like gold, that's a direct headwind. The logic was clean, and the unwind was fast. Gold shed 14.6% in March alone, its worst monthly performance since October 2008. But stick with me here, because what the gold is dead crowd completely missed is the difference between a macro correction and a structural reversal. The reasons gold moved from $2,600 to $5,600 were never the Iran war. They were de-dollarization, central bank accumulation running at historically elevated levels, China extending its gold buying streak to 16 consecutive months, fiscal deficits expanding across every major Western economy simultaneously, the dollar's share of global reserves sitting at its lowest level since 1994. None of those drivers changed when oil spiked. None of them reversed when the Iran conflict started. Goldman Sachs kept its $5,400 year-end target after the March sell-off. JP Morgan is at $6,300. Deutsche Bank at $6,000. These aren't blog posts from gold bugs. These are institutional forecasters who watched gold fall 14% in a month and did not move their long-term targets because they can tell the difference between speculative froth getting squeezed out and a structural trend breaking down. The structural trend is intact. The Iran conflict created conditions for a violent correction of overcrowded positioning. That correction ran. Now gold is recovering. And the phrase I can't stop thinking about is this: the market is one shift in rate expectations, one softer inflation print, one dovish sentence from a Fed speaker away from closing the gap back to $5,000, a ceasefire signal, a cooler CPI, anything that changes the narrative around how long rates stay elevated. The recovery from $4,100 to nearly $5,000 in 9 days is not a fluke. It is the underlying bid reasserting itself once the leveraged paper got shaken out. Now let me bring gold and silver back together because the connection matters. That same March correction that took gold down 14.6% took silver from its all-time high of $121.67 all the way to $61 per ounce, a 50% correction in roughly 8 weeks. And here's the thing that will not leave my mind. Through every single week of that correction, the COMEX registered vault kept draining. The price of paper silver was cut in half. The physical drawdown continued anyway. That is not normal commodity behavior. When a commodity price drops 50%, the delivery dynamic typically normalizes. Buyers who were urgently pulling metal slow down. Sellers who had been sitting on inventory start offering it. The market corrects itself. That did not happen in silver. The registered pile kept declining through the entire sell-off. What does that tell you? It tells you that the entities removing silver from COMEX vaults are not financial traders reacting to price signals. They are industrial users, strategic accumulators, and institutional buyers operating on timelines and rationale that have nothing to do with whether paper silver is at $121 or $61. They need the metal. They took the metal. The spot price was irrelevant to their decision. Now silver has recovered to roughly $74 to $76. The paper price has bounced. But Tuesday's delivery report, 3 contracts, 15,000 ounces, is suggesting that whatever happened to the free float of registered deliverable silver during that correction, it has not been replenished. And that is the question that I think matters more than any other single data point in the silver market right now. Here's the mechanical picture. The registered silver pile, metal that is warehoused in COMEX-approved vaults and actively warranted for delivery, has been declining at roughly 13% per month. The eligible pile, which is silver sitting in those same vaults, but not yet warranted for delivery, has been largely flat. That distinction is critical. When registered silver leaves, it is not converting to eligible. It's leaving the COMEX system entirely. And eligible metal is not converting into registered to replace it, even at price levels that should make that conversion economically sensible. Eligible holders at $121 were not offering. Eligible holders at $61 were not offering. They're sitting on it, either because they believe prices go significantly higher, which would be a rational bet, or because some portion of that eligible stockpile is already informally committed elsewhere and cannot actually be warranted and delivered even if it technically sits in an approved vault. I cannot tell you which of those is true from public data alone. What I can tell you is the observable behavior. Eligible sits flat, registered drains, and the free float has apparently contracted to the point where on day 2 of an April delivery period, the entire COMEX silver apparatus produces 3 contracts. That is the number we need to keep watching. Let me say something directly about what the gold market is revealing in parallel, because I think it's being completely underreported. Gold's worst month since 2008 happened in March. ETF shares were sold. Leveraged futures positions were unwound. The financial press declared the trade dead. Meanwhile, physical gold deliveries on the COMEX are running at 11 times the pace of physical silver deliveries in April. 11 times. The institutions that sold gold's paper products in March were financial players reacting to rate signals. The institutions standing for physical delivery on the COMEX were not the same people. They kept showing up for gold. They kept showing up for platinum. The physical market did not capitulate with the paper market. The physical buyers and the paper traders are operating in different realities right now. Silver is the most extreme expression of that gap. Paper price down 50%. Vault drain uninterrupted through the entire correction. And now, on day 2 of a delivery period that opened with 1,181 contracts, 3 contracts on Tuesday, either demand front-loaded completely onto Monday and the system is functioning normally, or the free float of deliverable silver has quietly, without announcement, without a headline, effectively seized up. And what we are watching is a paper market continuing to operate on top of a physical market that has begun to show its limits. Watch Wednesday's delivery report. Watch Thursday's. If silver delivery notices stay near zero for the rest of this week, the second explanation becomes very difficult to dismiss. Because platinum with a smaller market, less institutional attention, and a fraction of silver's global profile managed 398 delivery contracts on the same Tuesday. Silver managed 3. That asymmetry is not noise, it's a signal. Let me put the full timeline on the table, because context is everything. In January, silver ran from $80 to $121 in 3 weeks. In February and March, it fell from $121 to $61 in 8 weeks. A 50% correction that coincided with the Iran war, the strongest monthly dollar performance in years, and the evaporation of rate cut expectations. Through all of it, the vault drained. Silver is now back near $74. Gold is recovering from $4,100 toward $5,000. Platinum is processing 398 delivery contracts a day, while silver processes 3. The registered pile has been declining 13% per month. The COMEX stress indicators, coverage ratio, vault outflows, paper leverage, inventory trend, are all in stress territory simultaneously. The paper price tells you what traders think about the dollar and interest rates. The delivery report tells you what happens when someone actually tries to take the metal. Tuesday's report said 3 contracts. That is the number I'm watching this week. If you think this is the front-loaded demand explanation, or if something in the data is reading differently to you, drop it in the comments. I want to hear it. If you're new here, this is the kind of analysis we run every week on Currency Archive. Hit subscribe and turn the notification bell on so you don't miss the Wednesday and Thursday delivery reports.